Hi, I want to thank you for taking the time to watch this presentation where we're going to be discussing today's long-term care strategies. I've got a great guest speaker that I'm excited for you to meet, but first let me introduce myself. And a little caveat here, we're on Michigan COVID lockdown, so if you see a little white creature walking across the room, that's Humphrey Bogart. Just ignore him, he'll be quiet. For those of you who don't know me, I'm Denise Grace, and I own Grace Financial Group and our new venture, Women Empowered by Grace Financial Group. We primarily service families and individuals who are near or in retirement with a focus on asset preservation and conservative but meaningful growth. And planning for long-term care is an important part of your asset preservation strategy. So let me introduce you to my guest speaker, Alicia Barnett, Senior Vice President of the Care Planning Division at Financial Independence Group. Alicia holds a certification in long-term care, and she's a long-term care research and design specialist with over 20 years of experience in the industry. Alicia has an incredible presentation for you. So with that, I'm going to turn it over to her.
Thank you so much, Denise. Just glad to be here today. I know now more than ever, health is front and center, and we're just seeing some unprecedented times. And I believe now is the time to really start thinking about long-term care and care planning. So we'll get started and talk a little bit about long-term care. But before I do, I want you to start thinking while I'm talking here and kind of going over some information. So when you hear long-term care, typically, what would be the first thing that comes to mind when, again, hearing long-term care? Most people in the audience have probably gone through a long-term care event with a loved one. If you have, be thinking about, what was that experience like? Where did it occur? Were you providing the care or were you coordinating the care? What was that? Was it rewarding? Was it difficult? Did they have a plan in place, or did you just have to reactively deal with this? Those are some of the things I want you to think about as I go through this information today. We're going to walk through a couple different stages of this, and hopefully you'll leave here with a better understanding of what long-term care is, what are the options of paying for this, and how we might be able to essentially add more efficiencies to your plan. So there are 4 major myths of long-term care I want to discuss. It won't happen to me. So how many of you think that you're going to need some type of care in your life? Be thinking about that. People really tend to downplay their personal risk, often assuming that others face a greater risk of needing care. And the reality is that actually the risk is much higher for everyone. We're going to talk a little bit more about that risk in a few minutes. Let's talk about the next myth. Many people think the government is going to pay for care. Medicare is really only covering up to about 100 days of skilled care, and there are stipulations that go along with this. So you'll have to be admitted to a hospital for at least 3 days. You also have to show signs of getting better. So it's really short-term care, not long-term care. These are some of the stipulations that Medicare will require in order to pay for up to those 100 days. Also, the last thing is most people don't want to spend down their assets to be placed into a Medicaid facility. So Medicaid is a great program for those that need it, but you certainly don't want to spend down your assets. There are also a lot of misconceptions on how you qualify for Medicaid. Again, it's good for those that need it. However, most of the people that I know have worked really hard on financial planning and building out for a future to obtain certain goals, and the last thing they want to do is have to get rid of all their assets to be placed into a Medicaid facility. So the third myth is that's what my savings are for. How many of you are aware of the cost of care in your area? Be thinking about that. Maybe you have a friend or a family member that's receiving care. If you're not sure, what I recommend you do is go to the current cost of care in your area. Now, this is an example of Chicago, so the costs are going to be a little bit different in your area depending on where you live. But the good thing about this is a government website where they tell you to go to get all the information that you need in regards to long-term care. So as you take a look at the website and you scroll down to the bottom, you're going to see in the tools area cost of care in your state, and you're going to click on that. That link's going to redirect you back to the Genworth Cost of Care Survey. This is just a small example of what this might look like. You'll type in your city, your state, and it will actually bring up the local cost. So in this example, again, this is Illinois, but the average cost, as you can see, for home health care is around $4,700. Adult daycare is around $1,500. Assisted living is around $4,700. And then nursing home costs are considerably higher, around $92.77 a month. But the idea here is go and check that out, because some people really don't understand how significant the costs are. There's a nice little sliding scale as well that you can use to show out future costs, because many of you that are looking at this information probably won't need care today. So what's that going to look like in 15, 20, 30 years? So it will project out the cost based on inflation. So you'll see maybe in the future what those care cost. So in this example, in 2039, you know, we're talking 20 years later, that's going to show you what it will cost, which is significantly higher. For example, the nursing home went from $92.77 to $16,755. So I encourage you to go check this out because, again, most people aren't really aware how expensive that it could be. And that the other thing they don't understand that is if you don't have a plan, by default, your money is your plan. Think about which asset you would actually have to liquidate in the event of care, because this is quite an expensive, you know, a bit pretty expensive venture. If you were to have to use care for nursing home, assisted living, or home health care, it could really deplete those assets. So just remember, your money is your plan. Let's take a look at how we can alternatively cover those costs. So the last myth is my family will take care of me. So do they know what this will look like? Most people, obviously, if your loved ones care for you, they're going to take care of you. But what does it look like? Long-term care events don't happen just to you. They happen to the whole family. Ensure that you and your loved ones are really on the same page and have a plan in place if the need for care arises. Really, the facts are that 61% of sons and 51% of daughters that were surveyed hope they don't become their parents' caregivers. And 68% of Americans surveyed agree that their children should not be burdened by having to provide the care. Another reality, caregiving negatively impacts women in the family. Those caring for ill parents are also twice as likely to experience depression or anxiety. And that cost is nearly $325,000 due to lost wages and diminishing working hours for the person that's the caregiver. So again, it doesn't happen just to one person. It does, in fact, happen to the whole family. So we're going to talk a little bit more about this in a few minutes, but we're also going to talk about long-term care in a different way. But before we do, I want you to take a look at this. Denise, I know you have a personal experience with long-term care, and I'd love it if you could take a minute and tell us a little bit about your circumstance and what this slide is to you.
Yeah, this was our life, my siblings and my life for 8 months. A little bit of background. My mom had been disabled for several years, confined to a wheelchair. My dad was her primary caregiver, you know, helping her go to the bathroom, helping her get in and out of bed. But as he got older and more frail and more weak, he was able to do less and less of it. So we started out hiring a part-time caregiver, Marcia, who would do those heavy lifting chores for my dad, and my siblings and I would fill in whenever we could. Now, keep in mind through all of this, all four of us had full-time jobs. But as things got worse and worse, my dad fell and broke his hip. Therefore, he was not able to do anything for her. My mom needed 24/7 care. So, you know, just kind of threw all of our lives upside down. Dad was in the hospital. Dad was in rehab. Mom needed the care. So my sister would put these schedules together for us every week. And this went on for 8 months. And as you can see, you know, some of our time slots, you know, 2-hour shifts, whatever we could do. Marshall was a caregiver. Amanda was a caregiver. Numbers 11 and 13, we still didn't know who was going to cover for those weeks, for those days. So, like I said, it went on and on. A couple months after the hip break, my dad was diagnosed with terminal lung cancer. So, you know, we just pulled together I was fortunate enough to have siblings where we all got along and we all pitched in as much as we could. Um, but, it just got more and more difficult, more and more stressful. After about 8 months, my mom passed away. That same night, my dad was rushed again to the hospital, never came home. Um, so we never had time to mourn my mother because we were at the hospital every day with my dad. 9 days later, he passed away. Blessing in disguise for them. And, a sad relief for us because it wasn't until it was all over that we kind of were able to take that deep breath and realize how much stress and pressure we had been under for all of those months. And it just, I treasured every minute I had with my parents. But I can't help but think what it would have been like if, we had been able to be there and care about them and spend time with them instead of taking care of them. So, what I would say, my advice to everyone is just have that discussion with your spouse, with your family, have a plan in place before, you're forced into something that you're not prepared for, whether that plan is long-term care, a child that will step in and take over full time. Have that conversation with your family and your friends and have something in place. So thank you for letting me share, Alicia.
Oh, thank you, Denise. I mean, that is a really profound story. And, like you said, you're very fortunate that your siblings stepped in. Oftentimes, one person does more of the caregiving than the other, and it doesn't bring families together. It tears families apart. So you are very, very fortunate, and I'm glad your experience, even though you had to take care of your mom and certainly supervising the care rather than providing the care would have been better. I'm glad at least you had family members that did come together and care for you also. So thank you again for sharing that. Again, we're going to talk a little bit differently about long-term care today. So we'll move on and continue. So let's take a look at, let's again talk a little differently about long-term care. What would you think a goal when climbing a mountain would be? Most people would say probably to get to the top, right? Actually, the answer should be really getting back down the mountain successfully without breaking that neck or that back. Again, getting down that mountain successfully. So many baby boomers have reached the top. They have completed the accumulation phase, and now they are starting to retire and enter the distribution phase. This is why we're seeing a lot of focus on retirement income and retirement income strategies. So that's why you're probably talking a lot with Denise about those things. So what can really interrupt that descent or that distribution phase? So what concerns are there in the distribution phase? Having enough retirement income, maybe the low interest rate environment that we're in right now, more rising healthcare costs, but more specifically, having enough income to pay if you were to need some type of care. So in your retirement years, what would be the reason that suddenly your income needs skyrocket? Let's take, for example, let's say you're living well on $100,000 per year, and suddenly you need to take an additional $70,000 per year. So on top of that $70,000, you're taking $100,000. So that's a total of $170,000. What do we think would cause that to happen? So most would say some kind of health issue. Would you agree, Denise? Absolutely. So, or maybe you or your spouse have become frail and need assistance in your home, or maybe in a care setting. Where would you get that additional $70,000 per year? So when your income needs suddenly skyrocket, where do you get the income to fill what we call the gap? Most people are going to liquidate investments such as managed accounts, maybe annuities, cash or cash equivalent, or what I like to call your conservative assets. Long-term care is an income issue. It is not an asset issue. So is this going to affect your retirement income plan? Will this affect you? Will your assets last? If you begin withdrawing money out of these accounts that Denise helps you manage, is that going to affect you? Can you get a rate of return maybe high enough to get that additional $70,000 per year in the example that I gave for the entire length of your illness, which could be 5 years, 10 years, 15 plus years, if it's maybe a cognitive impairment of such? So this diagram describes what we call the great income gap. This is, again, an income issue, not an asset issue. So in this example, if you retired at the age of 65, your income is, say, for example, $100,000 per year, but at age 75, you begin to have some health issues, and maybe you need more income. You can probably afford to absorb a little bit of the cost because you've done well, but let's say at age 80, you have a diagnosis of Alzheimer's. It could really become an issue because it means you're spending more and more per month than you would actually plan for. This is what we call the great income gap, right here. So from 80 to 90, for example, if they needed care, where are you going to get that money? We really need one more piece to fill that gap. Okay, so let's take a look at some of the issues. I'm not sure if you're aware, if you've heard these statistics, but they are astounding. 5.4 million Americans have Alzheimer's, and this was in 2016, so these numbers have actually increased. 1 in 9 people aged 65 or older has Alzheimer's. By mid-century, they're saying that 1 person every 33 seconds is going to develop Alzheimer's. Again, another astounding statistic. And these numbers are expected to triple in the coming years. So definitely going to have a problem on our hands. So many of you have heard the statistics that 70% of people over the age of 65 are going to need some type of care. 1 in 5 will actually need care for 5 or more years. And here's the biggest problem. Most people believe they're in the 30%. And since they believe they're in the 30% and they don't think it's ever going to happen to them, they don't put a plan in place. But here's what we know. We know that most men and women make decisions to have a plan to protect those that they love, the people that will truly be affected when care is needed, like Denise and her siblings. Those are the consequences of not being properly prepared. Being unprepared for an extended healthcare event can have a big impact, not just on your life, because people are going to stop and take care of you. Regardless, it's going to have consequences for your spouse and your family. Your spouse probably will feel an obligation to take care of you, or maybe their financial situation will dictate it. And the stress and responsibility of being a primary caregiver can make the caregiver ill as well. I watched my mother take care of my dad before he passed away in March, and she had back issues from sitting in the hospital all day and from trying to help him. It definitely made her chronically ill. When a spouse isn't involved, other loved ones carry the burden. When you need care, your life doesn't end. Again, someone's going to take care of you, and someone else's life may end. Often the eldest daughter quits their job, moves in, or maybe her parents move into her home. She might give up her career, as any decent child would feel obligated to do. And again, as I said to Denise earlier, most of the time long-term care doesn't bring families together. It tears families apart. So how do we create this income stream to fill the gap? There are really 2 ways to backstop against the long-term care risk. You have traditional and asset-based long-term care. I like to use the analogy owning your contract versus renting it. Traditional long-term care is like renting, which isn't a bad thing. It's probably the cheapest way to buy the most amount of long-term care. However, rates can go up. If you don't use it, you lose it. There's no exit strategy. Then you have asset-based long-term care policies. They have a benefit whether you live, whether you die, or whether you quit. It's kind of an alternative to traditional long-term care, and I'm going to go over some examples here shortly. So if you were to self-fund, this is an example or an option that may work for you. This is the concept of asset-based long-term care. So if your portfolio has a moderate, conservative, or aggressive type assets, again, as I talked about earlier, most prefer to use their conservative assets first if needing care. The government has allowed certain life insurance or annuity contracts to be accessed while alive, tax-free for expenses associated with needing care. So by using this option, you could actually reposition an asset or income into one of these products to provide an income stream of money tax-free to pay for long-term care expenses to avoid pulling money directly out of the other investments. And lifetime benefits is an option that will fully cover the length of an extended care needed just due to your longer longevity claims like Alzheimer's, Parkinson's, and dementia. We rarely get asked, how does this work if I die? Most people understand that life insurance, how they work, life insurance and annuities when someone passes away. However, we rarely get asked, how does this work if we need care? So I'm going to show you that and how that works in just a minute here. So there are 4 ways to fund an asset-based long-term care plan. You have your highly appreciated non-qualified annuities. I'm going to, again, go over some examples here in a few minutes. Cash or cash equivalent, or what I like to call your debt assets or your rainy day funds, maybe money sitting in the bank that you're not using. Qualified dollars, because I know many of you have a disproportionate amount of money in qualified dollars. And then last but not least, income. If you don't want to reposition an asset, you can pay for this just like you can the traditional long-term care using income. So let's start with our first example. This is a married couple that's done a great job with income. They've prepared for retirement with the exception of LTC protection. They have an existing annuity they're not using for income. So we're putting $150,000, we're moving it from our right pocket to our left pocket. This is going to provide them $60,000 roughly per year, tax-free income specifically for care. It's going to give them a $450,000 tax-free pool of money. So again, by moving our money from our right pocket to our left pocket, the $150,000 is going to turn into $450,000 tax-free for long-term care purposes. If they don't use it, then that $150,000 is going to go to their beneficiary. So they haven't lost it. It's still an asset on the balance sheet. And guess what? Investing $150,000, if we're on the conservative side, let's say it would take approximately 5% return of their money on a tax-deferred investment. It would take them 22 years to equal $450,000. This is a 70-year-old couple. And again, this is going to give them $450,000 day one. If we invested $150,000 at 5% return on taxable money, it would actually take them even longer. It would take them 29 years to equal $450,000. They understood they wouldn't be, this couple did, that they would not be able to earn enough interest in any accounts to equal the income that this policy provided. The accumulated value and death benefit was secondary, but they did like the fact that, again, if they didn't use it, they didn't lose it, and their family would receive this if this the $150,000 plus any interest earned if they never used it for care. So let's move on to our second option. This is a married couple, age 60 male and 60-year-old female. They have a CD. They've also done a great job with their income and preparing for retirement, except for long-term care protection. They're not concerned with needing care for the average length of care or stay because they've accumulated some assets. So they can probably afford the first couple years, 2 to 4 years, but they want to make sure the longevity care is covered if they need it. Their main concern is if one or both of them, again, had a long claim due to Alzheimer's, Parkinson's, or dementia. They understood that lifetime benefits are the only options to cover this need. So here in this example, again, we're going to reposition $150,000. It's going to provide each of them $68,000 a year lifetime income. So if their care was 5 years, 10 years, 15 years or more, it's still going to pay out a lifetime income of that $68,000 per year. If both of them need it, it's going to provide $136,000. That's so $136,000 per year for both people, lifetime income specifically for care. If they don't use it, they don't lose it. It's going to provide a death benefit of $189,000. So $150 turns into $189 for their beneficiaries. And if they invested $150,000, it would take approximately 45% guaranteed return on their money to generate that $68,000 a year. Right now in this low interest rate environment, it'd be pretty hard to do that. If both needed care, it would take 90% return on their money to generate that $136,000 a year for life per person for both of them. So it's a great use of their money. We're repositioning $150,000. If we live and need long-term care, we have a long-term care benefit. If we die and don't need long-term care, we've got a death benefit. If they want to quit, these policies also have, they can get some or all of their money back depending on which carrier that you go with. It's really not a one-size-fits-all approach. So as you're looking at these examples, know that you probably need to meet with Denise to talk about your own specific circumstance, because it's not a one-size-fits-all approach. So just keep that in mind as well. All right, so let's talk about our next example. This is a married couple, age 70 and 71. Now, the RMD, or retired minimum distribution, has changed. It's now not 70 and a half. So just know that you can start RMDs early. In this example, that's what we're doing. So this married couple's retired. They're living comfortably. This is before they changed the rule to 71. So she was required to take RMDs. He will need to start his soon as well. They don't need the retirement minimum distribution. I don't know how many of you are taking distributions and you're like, well, what do I do with this money? So this is a great way to utilize RMDs. So they also don't have a long-term care in place because they don't want to deal with an expensive policy where premiums may increase on each year or down the road. They're now interested in long-term care protection because they have family and friends that have had experiences. They like the idea of benefits passing on to their grandchildren if not used. So here in this example, we have a $200,000 IRA we're going to transfer into the product, and then internally, they're going to take $24,000 a year. We'll call it an internal required minimum distribution. That is a taxable distribution, but we're only taking it out over 10 years. And we're spreading that tax liability out. We're moving it from a taxable account to a tax-free account. But here's the beautiful thing. If they need care, it's going to provide $51,000 a year, tax-free lifetime income stream specifically for care. If they both need care, it's going to provide $102,000. So $200,000 over from your right pocket to your left pocket. It's going to provide $51,000 if one of them need it, $102,000 if both need it. Again, lifetime tax-free income stream for long-term care purposes. If they don't need care, we're going to get a death benefit of $212,000, minimum death benefit of $212,000, tax-free to the beneficiary. And just think, if we invested $200,000, it would take 25% guaranteed return of their money to generate $51,000 for lifetime for one. It would take $200,000 at 50% return on the investment to generate $102,000 for life. So it would be very difficult to do that. The clients understood this, and the premium was, on this particular example, was based on the total required minimum distribution that she needed to take, which was approximately $24,000 a year. So they understand the cost. This will supplement their pension, Social Security, and long-term care policy will pay for care if they need it. So a great use of those RMDs and qualified dollars. Let's take a look at one more hypothetical example. We have a 58-year-old male, 58-year-old female. They have high income. They'd like to cover all aspects of their retirement strategy. They saw what their grandparents went through and how their parents had to do the caregiving, and they want to keep this from happening to their children. They'd rather have their children supervise the care. He has a health savings account. He likes tax-free money, and he has plenty of life insurance. So for $72.45 a year, we can get them a policy, and around $3,000 of that he used his HSA to pay for it, so that's tax-free dollars. It's going to provide them $60,000 a year lifetime income stream. It's going to provide them $120,000 lifetime income stream if both need it. So $72.45 a year, it could provide them up to $120,000 per year for both of them, tax-free for life. If they die and don't use it, It's a $166,000 death benefit. This couple really didn't care about the cash value. They didn't really care about the death benefit. It's just an added bonus if they never needed it. They really are just concerned with the shortfall or the gap of income that is needed if they were begin to need assistance. They also wanted to make sure that their premiums are guaranteed never to increase. So back to the differences between traditional and asset-based long-term care. Traditional, again, is typically cheaper, but, and again, the owning your contract versus renting it, with a traditional, those rates can go up. So that's one of the downsides of owning a traditional contract. There's also no cash value, no exit strategy, and no death benefit. So this might be a little bit more at $72.45 a year, but those premiums will never ever go up. Again, if they wake up an angel and don't need care, you've got a tax-free death benefit. And if you need care, you have a lifetime income stream of tax-free dollars for LTC purposes. So it's a great way to fund a plan. You don't have to use lump sum or single premium dollars. So if you're not in a position to reposition an asset, you can use income to fund the plan as well. So again, just keep in mind it's not a one-size-fits-all approach. Definitely make sure you run your specific example by Denise. With that being said, so begin having the talk with those in your life that's going to be making decisions on your behalf. Express to those that to your loved ones your desire for care, and discuss their care if necessary. Next, you're going to meet with your financial. So meet with Denise. Go over all of the different options that are available for you, because there are so many. And most importantly, after you have decided the best plan for you, complete the plan and set it in motion. Tell your loved ones what your plan is so they can follow your wishes. Whatever you decide, do it now. Don't delay. You're never going to be younger and healthier than you are now.
True.
For more information or to schedule a meeting, here's some information for you. You can go straight to Denise's calendar through Calendly and schedule a 30-minute appointment or free consultation. Denise's email is attached, and then, of course, her phone number at 248-345-1250. So make sure to contact and reach out to her if you have additional information. Again, you've never been younger and healthier than you are now, and we look forward to hearing from you. Thanks, Denise, so much for allowing me to be on here today. Let us know how we can help.
Thank you so much, Alicia.